Okay, welcome everyone. Thank you so much for joining us at today's webinar. We're doing this as a pop-up event. So this is the first time we've had the opportunity to do something like this. And it's basically your 30-minute info injection. And we're very fortunate to have Adam join us on our very first one. And Adam is going to be talking about credit, which if you are new to the world of investing, doesn't take long for you to figure out, this is really important to me. If I want to be able to do any deals on my own, or if I want to be able to secure some financing. It's not essential anymore in the world of, private lending and those kinds of things, but it certainly is important if we want to buy some properties on our own. So thank you so much, Adam, for joining us today and for being our credit expert. So for those of you who don't know me, my name is Elizabeth Kelly. I've been a real estate investor for 15 years. I was a trainer for Rich Dad Canada for 8 years, and I recently opened my own coaching and consulting company where I help new investors and I'd say sort of intermediate level investors really figure out what their plan is and then chart the path for how they're going to achieve those goals in the shortest possible runway. So whether people are looking to leave their jobs or whether they're looking to supplement their income, I help you figure out the right strategy, the right timing, and the right people to work with in order to make that happen as quickly as possible for you. We are very fortunately joined by Adam. Adam is a mortgage agent with Capital Lending Center based in Toronto. And Adam's goal is to empower Canadians to reach financial freedom by growing their wealth through real estate. One of the things we love the most about Adam is that he is an investment-focused mortgage agent. And for those of you, again, who are a little newer to real estate, you might not realize, but there really is a very specific order that you want to approach lenders in. Each lender has their own criteria for who they will and won't lend money to. So we don't want to do something called capping out or maxing out. Right at the very beginning of our journey, we want to ideally get as many of those low interest mortgages from A lenders and then B lenders as possible. And then there's contact information for where you can find us at the end. I will bring that screen back up again. I'm going to stop my share and say, Adam, thank you so much for joining us today. I'm just going to do a little bit of housekeeping to make sure that everybody's on the same page, and then we'll turn the reins over to you and let you get going with teaching us. So for everybody, there is a chat box, and then at the bottom in this webinar, there's a Q&A box. So if you would like to interact with Adam, if Adam asks questions and you want to provide responses, please use the chat box. You can use that to chat back and forth amongst yourselves as well. Just make sure at the bottom you click all panelists and attendees so that everybody can see. Otherwise, typically you will just be messaging the panelists, and Adam and I are the only ones who will see that. If you have specific questions, Adam has promised he is going to stick around. So his presentation's about 30 minutes of information, and then he's going to stick around for another half hour and answer questions. So if you have questions that pertain to the material Adam's covering, please put them in the Q&A box. If you put them in the chat box, they will probably get lost, and we don't want that to happen. Your questions are important. So chat box is for chatting, Q&A box is for questions. I think that probably makes sense for everybody. And we're super lucky. This is our first time doing this, but Adam has some awesome giveaways for people who are attending. So Adam, I am really excited about this, and I'm going to turn it over to you and let you lead the show from here. So I will mute my microphone. I'll keep an eye on the Q&A in the chat box. I'm here if you need me, but over to you, and thank you again.
Awesome. Well, Elizabeth, thank you very much. I really appreciate the awesome introduction and getting to come out and do this with you. So thank you. Guys, as Elizabeth mentioned, I do have a really great giveaway for you guys. We're going to get to that at the end. So please do engage, interact with us as much as possible. If you have questions, please, don't keep them to yourselves. Get them in the question box so I can answer those for you at the end. But without further ado, we're going to be talking about credit for the real estate investors today. As Elizabeth touched on, this is a very important subject as you're growing through your real estate investment career. We're going to start right from the basics. We're going to talk about a basic overview of credit, how credit is made up. We're going to talk about how to improve your credit. We're going to talk about how other people's money can affect your deals and how we have to look at that when we're doing credit adjudication. We'll talk a little bit about personal credit versus corporate credit, and then we'll do an overview of commercial commercial financing and commercial qualifying for those of you that are starting to look into the multifamily space. So usually when I have a conversation with somebody about their mortgage, one of the first things they always tell me is, no, don't check my credit. I don't want you to ruin my score. So over time, I've learned that this is how Canadians see their credit. 80% of it is made up of the dreaded credit check, and we're going to ruin your score each time we check it. So I want to dispel this myth and let you know how it's actually calculated. So as you can see here, it's a minor little portion, but definitely something that we do want to pay attention to. But we'll touch on each individual aspect here as well. So 35% of your score, largest part of your score, as you can imagine, is do you pay your bills on time? Simply paying your bills on time will help you increase your score over time. I always advise that, on unsecured lines of credit and credit cards, if you can pay off the full balance each month so you're not paying interest when you don't have to, make sure you do that. If you're not able to do that, make sure you at least make that minimum payment more if possible. Never miss a minimum payment. If you have a rental property and your tenant doesn't pay you on the first, and your payments due on the first, you still must make your mortgage payment. Otherwise, these late payments are going to start to decrease your score over time. How much of your limits do you use? This is credit utilization. Essentially, your balances divided by your limits gives you what your utilization is. So if you have a large amount of limit available to you, say $20,000, $30,000 in a credit card, but you're maxing that out each month and using the full amount, you have 100% utilization. This is going to really impact your score over time. I always recommend keep your utilization to about 30% or less of your total available limits whenever possible. 30% or less, and that will help you increase your score. Once you hit that 70% mark, that 70% utilization, this is when you're going to start to see a big drop off in your score. So be very cognizant of what balances are outstanding. Length of credit history. So the longer you've had credit established for, the better it's going to look. Now, if you have old credit cards that you don't use anymore and you don't want to bother with, and you don't want somebody accidentally gaining access to that account, you want to go ahead and close them. Don't do that, because what happens is when you close those old accounts, all of a sudden your credit looks newer, and sort of newer credit is not as good as older, well-established credit. So always keep the old accounts open. Cut up the cards and just monitor your credit score each month so you make sure that there's nothing going on there that you're not aware of that you don't want happening. How many sources of credit do you have? This is sort of diversification. Do you have just a handful of credit cards, or do you have a mortgage, a car loan, a credit card, a line of credit? Now, for those of you that are a little bit newer to credit, and if you're concerned that, oh my goodness, I only have a credit card, I better run out and get everything. This is a very minor part of your score. This is really going to be the cherry on top of your credit down into the future. As you start to grow, mature in your credit, just diversifying your sources of credit will help you improve that score even further. And then finally, the dreaded credit check counts again for about 10% of your score. I advise you don't go run out and apply for new credit each month. If you're applying for a credit card this month, a car loan next month, mortgage next month, and so on and so forth, you're slowly going to drop that score over time. But when you're going through the pre-approval process and you're having a conversation with your mortgage broker and they say, we need to check your credit, absolutely, you definitely want to get that done, because if there's any issues in there that are going to impact your future financing, you want to know about them before you put that offer in. So credit checks, very minor portion. We might see about drop off about 10 to 12 points on a mortgage credit check, but really that number is going to jump back really quickly anyways, because you can see the other factors that make up your score provide a much stronger basis for what your score is calculated on. Okay, so 4 tips to improve your score. Pay your bills on time, even if it's just the minimum. If you're running into a cash flow situation and you're worried that you might not be able to pay, make the minimum payment next week, call up your credit provider and say, hey, look, this is going on. I just need to move this payment back a little bit. They're very willing to work with you, and they'll move those payment dates back so it doesn't hit and impact your score over time. So make sure you get that minimum payment made on time. For those of you that have rental properties, I typically recommend that if your rent is due on the 1st, that your mortgage payment shouldn't be due until the 5th or the 6th. That way, you do have a little bit of leeway for that tenant to make that rent payment so that the money can hit your account. There's no holds on it, and you can get that mortgage payment out without any issues. Utilization, I already touched on this, that we want to keep your utilization less than 30% of your score. So don't be maxing out your credit cards and your lines of credit. Really try to use only about 30% of those limits each month. Just so you know that when we look at your credit score, it's actually just a snapshot in time. So if you have a $10,000 line of credit that you go out and make a $10,000 purchase today, and they report to the credit agency today, and then you pay it off tomorrow, well, the credit agency is going to see that you have a $10,000 balance. So if you're able to spread out larger purchases onto several different credit cards and lines of credit, that's going to be more beneficial than maxing out a single card or single account in any given month. Consolidating unsecured debt. So if you do have large balances in your credit card lines of credit and you're over that 30% mark, or worse, you're over that 70% mark, a lot of times what we do is we just consolidate it through a mortgage refinance. For our clients that are having a little bit of credit issues because they've been having high utilization, it's dropped their score, say down into the 500s. A lot of times it makes sense to get a second mortgage at 11, 12%, to pay out credit cards that you're paying 24% on, get them consolidated. Those credit cards are now empty, your utilization is at zero, and your score should start to jump back up. And we're then able to start to refinance and restructure that debt into a lower monthly cost. So consolidating unsecured debt and lowering your utilization. And finally, utilization is your balances divided by your limits. If you have a $5,000 credit card with a $3,000 balance, that's 60% utilization. If you call up your financial institution, say, hey, I'd like to increase my credit limit, and they're willing to double the credit limit to $10,000, that same $3,000 balance is now just 30% utilization. So increasing your limits can also help you increase your score. This does come with a bit of a caveat. If you feel that you're having difficulties managing your credit and managing your finances, and that you're living on lines of credit and credit cards, this last option is probably not one that I'd recommend for you. So just make sure that you do have a full understanding and strong hold on your finances before asking for increases on your lines of credit and credit cards. Okay. So OPM, other people's money. It's great to be able to get into real estate deals with other people's money. We just got to know how that's going to affect your debt servicing and then lender types that are going to be available to you. So we'll talk about 4 factors here to think about. So we're talking JV partners, joint venture partners versus AML. AML stands for anti-money laundering. So whenever we do a mortgage transaction for a purchase, we have to determine where the source of down payment came from. We have to track that money for 90 days. Any large deposits into that account, where it's coming from, we have to track those for 90 days. This is anti-money laundering legislation that the government places upon mortgage lenders. So what this does is, if you have a JV partner that's giving down payment and your mortgage lender doesn't allow, and you're qualifying for the mortgage, and your mortgage lender doesn't allow other sources of down payment other than from your own sources, your own cash, your own equity, you might have to have that down payment given to you by the JV partner 90 days prior to actually going ahead with any sort of transaction. So being very cognizant of where your down payment funds are coming from, how those are going to affect the deal, how the joint venture partnership is going to be structured between the money partner and the working partner, whoever's carrying the mortgage and bringing the down payment, is really going to have an impact on when you need to transfer that money into the account or what type of lenders you're going to be approaching. Cool. Went the wrong way. There we go. Joint venture agreements and lenders. So if you're going to be the working partner and you're having a money partner come in on the deal, and you want to have a joint venture agreement, a trust agreement between both parties to lay out what the ownership structure is and who owns what. The majority of mortgage lenders will not allow anybody on title who is not also on the mortgage. So if you're not going on the mortgage, you won't be able to be registered on title. Now that trust agreement protects you. However, the second you take that to your lawyer, and your lawyer is registering that mortgage charge, they have a duty to report that to the mortgage lender. So if you're arranging your financing with Scotiabank and they bring that trust agreement to Scotiabank, all of a sudden your deal can fall apart. So just knowing how those agreements can affect your deal and how to properly register them. Elizabeth is recording this this webinar. I do have some advice around this topic, but I'd rather talk about it when we're offline. Lines of credit and debt servicing. So if you have an unsecured line of credit and you're planning to use that for a portion of your down payment funds, that's fine. Some mortgage lenders will allow you to borrow down payment. Just know that we have to use 3% of the balance of that unsecured line of credit in the debt servicing calculations when we're doing your loan. What this means to you is that $15,000 on an unsecured line of credit can reduce your borrowing capacity by $100,000. So that's something to keep in mind as to where that down payment is going to come from and how that's going to affect the deal. Now, home equity lines of credit, we don't often see down payment coming from unsecured lines of credit. We see it coming from home equity lines of credit. Just know that we have to use the balance of that line of credit, or sometimes with some lenders, the limit, and we're going to calculate it at the Bank of Canada posted rate, which is 4.79%, which is higher than a mortgage rate, and amortize it over 25 years rather than 30 years, as a mortgage may be. That is the payment that we use in the application. That's not the payment you're making, but that's the payment we use for the application's purposes. So what this effectively does reduces what you qualify for. Keep in mind, some lenders will use the full limit of the home equity line of credit. Now, whether you're using it for down payment or not, let's just say hypothetically, you've got 4 investment properties, each with a home equity line of credit of $100,000 on them. TD, First National, Manulife, RBC, and I believe CIBC will all calculate the limits. If those 4 properties have a $100,000 home equity line of credit each with a zero balance, we're still going to take about a $400,000 payment at 4.79%, amortized over 25 years. A large payment, which is going to reduce what you qualify for and can cap you out for mortgage volume. So understanding how that's going to affect you. So I just want to illustrate this point in a little bit more depth. So I've got a hypothetical situation here. A couple with $200,000 household income. They own their primary residence with a $500,000 mortgage. I've used a 25-year amortization on this mortgage payment here. They're going to pull $200,000 from their home equity line of credit. They qualify for up to a $740,000 purchase. $200,000 down, a $540,000 mortgage. So rather than using the home equity line of credit, instead, we look at doing a refinance. We're still taking out the $200,000. We're combining that with the $500,000 existing. So now we have a $700,000 mortgage. We bring the amortization out to 30 years, which can lower the monthly payment for debt servicing purposes. That same couple now qualifies about $1 million purchase price. We increase the maximum mortgage amount by almost $300,000 just by restructuring how we're getting the down payment for that property. So always making sure that you understand where the down payment's coming from, how we're going to use that towards qualifying, not only for this property, but for future properties as well as we're going through the process. Is really going to help you expand your portfolio more efficiently. So this is a topic I want to touch on just very briefly. I've often had potential clients come to me and say, hey, I'm going to place everything in a holding corporation. It's going to disappear from my personal credit and it's not going to impact my future deals. Wrong. Whenever you're placing a property into a holding corporation, you're still providing a personal guarantee. The directors of that corporation have to provide a personal guarantee for the loan. This means it reports on your personal credit. So that's fine. We decided to move into multifamily. We're going to get a commercial multifamily property. We're putting 25% down. It's going to go into corporate credit. Wrong. You're still providing a personal guarantee for anything over 65% loan to value. When you are putting more than 35% down and having a 65% loan to value mortgage or less for a commercial property, that is when some lenders will allow you to qualify with a corporate guarantee rather than a personal guarantee, and it does not appear under your credit. So you're not going to quickly get things off your credit just by putting them into a holding corporation. And in fact, not all lenders will allow you to get away from a personal guarantee, but sometimes with a mortgage of 65% loan value or less, you can use a corporate guarantee to back that loan and essentially remove it from your personal liabilities and increase your personal mortgage qualifying capacity. Okay, so this is going to be a very sort of high-level overview of commercial mortgage qualifying. There's so many different types of commercial properties. Every lender has different guidelines for these types of products. Typically, we do anywhere from 6 to 12 plexes. We do have an amazing team at Capital Lending Center who we work with for other projects, mixed-use projects, and larger multifamily residential. But we'll cover sort of the basics today. Your qualifying is a little bit different than when you're buying a residential property. You're not qualifying your personal income, you're qualifying on the property's income. So that's when we're going to start to look at things like debt coverage ratios. So a debt coverage ratio is essentially the revenue minus the expenses, which is your net operating income. So your expenses are going to be your insurance, your utilities, your maintenance, your property management. You're not subtracting your mortgage payment in this example. You're going to divide the net operating income by your mortgage payment. So let's just say in this example, a $5,000 revenue property, your monthly expenses come to about $2,000 a month, and your mortgage payment's about $2,500 a month. You're going to divide the $3,000 net operating income by $2,500. That gives you a 1.2 as your debt coverage ratio. So it covers your mortgage payment by about 120%. Typically, we want to see at least a debt coverage ratio or DCR of 1.1 to 1.3 on a property. And keep in mind that the better that property cash flows, the better that debt coverage ratio is, the higher it is, the better mortgage interest rate you're going to receive on that property. So it has a big impact on the deal. Experience is going to be something that comes to effect. When you're buying your first home, the mortgage lender isn't going, well, how experienced are you at owning a home? When you're buying your first commercial property, the lender's going to ask you how experienced you are managing these types of properties. If you don't own an investment property and you're deciding you're going to buy a 20-unit apartment building, they're going to want to see that you have a detail-oriented business plan in place that makes sense from their perspective, that you're going to have people that understand the management of these properties in key roles to make sure that it's managed correctly. So you want to make sure that you really have a full understanding of the type of investment you're looking to get into. It's a little bit different if maybe you have already a portfolio of 5 residential rental properties and you're looking to buy a 10-plex. They're going to look at it and see, okay, well, we've been able to manage these 5 properties here. A 10-plex should be just sort of another challenge that you'll be able to cope with quite easily. So having that experience level is really going to help you towards your commercial property qualifying. Creditworthiness is going to be more than just your score. It's who are you. I can tell you right now, mortgage underwriters are going into the 6th, 7th, 8th page of Google. They're probably the only people going that far on the Google pages, but they're really going to dig in and try to find out who you are as an individual. Have you always conducted yourself well? Is there a ton of good press about you on social media and other channels? Is there bad press about you on social media and other channels? Right? You're going to want to justify anything that could be in your past that a mortgage lender might be concerned about. A non-hypothetical example of this is the owner of our brokerage did have an individual who had a criminal record. There was a very easy and simple explanation to it. We just had to explain that to the mortgage lender, and they signed off on it. And there was no issues there, but it was still a question that came up. We just need to know what is it that's affecting the deal and how we're going to explain how that's not going to happen in the future to put that lender's security at risk. And finally, net worth. Net worth, there's really, some lenders do have guidelines around net worth, but most just kind of go by feel. We figure about a typical minimum liquid capital. It's going to be about $250,000. If you have a large portfolio and you're putting everything into your real estate investments and you have very little left liquid capital, that's fine. We just want to see that the existing portfolio has a very strong cash flow. We do have a lot of investors that pump most of their cash assets into real estate at any given opportunity and aren't as diversified as other investors may be. So as long as there's plenty of cash flow there. But we just want to see a very strong net worth profile. Essentially, the lender wants to know that if you default on their loan, you have other assets to fall back on and sell to cover the liability that loan. Lost track of myself there. That you have the ability to cover that loan with other assets in your portfolio. Okay, so that is commercial mortgage qualifying. So guys, hopefully you do have some questions for me. Oh, sorry, there we go. Last one, and we'll get to our giveaway here. So these are 3 common challenges that we do see when it comes to mortgage qualifying and credit capacity. Joint venture structure. We want to make sure we know what this is before we get to the deal stage. We want to know who's qualifying, where the money is coming from, how that deal is going to be structured before we take it to the lender. Some people have too much real estate and personal credit. Once you get beyond 5 investment properties, you're typically looking at alternative lenders. So knowing where we're going to be positioning this and see whether those mortgage rates are going to still allow that property to cash flow can be a very important factor. And then people that have insufficient credit or experience for the type of property they're looking to get into. So two very easy solutions to these 3 major challenges. You've probably heard of this one time and time again, but this is not just for first-time home buyers. It doesn't matter whether you're buying your first or your 10th property. Talk to a mortgage broker and get pre-approved. Ideally, give me a call and talk through the situation together, and we'll see if we're going to be able to get a mortgage solution in place for you and what it looks like. I'd say about 1/3 of my business right now is private mortgages. And of those private mortgages, 25% of them come from people who bought a property without getting pre-approved and scrambled around last minute to find a solution to close on the property. We don't want that to be the solution for you. We want to make sure we know where the money is coming from first. So speak to a mortgage broker and get pre-approved. For those of you that maybe don't have well enough established credit or have some issues with your credit, start monitoring your credit and making sure it's up to the standards that we require for our mortgage lenders. So we are going to be doing a giveaway, as I said. Today, I'm going to be giving away 5 Equifax Complete Premier packages. So this is an amazing product from Equifax. It only costs $20 a month. It's about $240 a year. We'll be giving away 5 of these. So please, the first 5 people to email me, sign me up, are going to get a code to get their free package. So make sure you're writing down my email address at the end of this presentation. You're going to be able to get alerted to key changes to your Equifax score, daily access to your reporting score. But most important thing that I love is they have dedicated ID restoration specialists. What this means is that if somebody accesses your credit, you're a victim of identity theft, you're going to have somebody there to help make sure that that situation gets sorted out. So make sure you do email me, sign me up, and I will get you the first 5 people a free code for that. But for the rest of you, don't worry, because we do have access to these. This is our pricing at Capital Lending Center. There is no markup on this. I am not making money off this. It's $18.75 for 12 months. Just reach out to me. I will get you the discount that we have on this product. Something that I really do recommend that you have. Oh my goodness, we got through to the end, Elizabeth, and I only messed up once.
There's no messing up. There's only learning opportunities.
There we go. I like that. So
that was great. Can I hop in and just I have a couple of questions for you, and then there's a couple of questions in the box. So if you don't mind, I'll ask you my question and then we'll go over to the ones in the box. Is that okay?
Absolutely.
Awesome. Okay. So I have a question because I know a lot of people when they're starting out in real estate, they don't realize how important credit is from a starting point. So if someone was to come to you and they have, a credit score, let's say it's in the 500s, and they follow the tips and the recommendations that you just gave us, how long would it take till they were in the 700s and could qualify for better mortgage rates? How long, what's the average length of time would you say to improve your credit score by, say, 200 points?
Yes, it's really going to matter what the circumstances were around why the credit score was that low. If it's things like delinquencies, collections items, bankruptcies, obviously that's going to take a little bit longer. There's other factors to consider there as well, because if there are collections items, we know that once those are paid off, it's still 2 years before you qualify with an A lender. So it doesn't matter what your score jumps to. But typically when it's just utilization, maybe everything's been maxed out, we refinance, consolidate the debt into a second mortgage or a new refinance first mortgage. Typically once the credit cards and lines of credit start reporting to the credit agencies over the next month, you're going to see a significant rebound. You might even see as high as 100 or 150 point rebound once those cards are paid off. So that's how important utilization is to your overall credit. So that's, to answer your question, with utilization, it could be as high as 100 to 150 point jump in about a month's time.
Wow, that's pretty significant. That's good to know. And the interesting thing about credit too is that it's not a formula that is released to anybody. Like Equifax and TransUnion, they keep, how they calculate your credit score. They keep that really secretive. So it's great that you're sharing this information and giving us sort of the opportunity to get a head start on managing it.
Yeah, one of the things that I just want to touch on there that I didn't really mention is that most of the consumer credit reports that you do find out there, that score, it's not really all that accurate. It might be in and around where your actual score is. When we pull a credit bureau for mortgage lending purposes, we have a score that is specific to mortgage lending purposes. I do believe with the Equifax Premier Complete package, that is actually the score that we see. That's what has been communicated to us. So it should be fairly accurate as to what your mortgage score would look like.
So you're talking about like the people who sign up for like Credit Karma and that kind of stuff. And the way that I sort of look at it is that credit's kind of like an onion. So when you sign up for Credit Karma, you're looking at the outer layers of the onion. But when you sign up for the Equifax that you're recommending, you're deeper in the onion. So it's more likely to be a very realistic score.
Yeah, exactly. I think that's a great analogy.
Oh, perfect. Fantastic. So we do have a number of questions here. Is it Bayer? I apologize if I mispronounce it. Let's go with Bayer. Is HELOC withdrawal an own cash? If I use my HELOC, should I withdraw earlier than 90 days to ensure compliance with anti-money laundering, or looking for advice on how to utilize the HELOC as the down payment?
Okay, so if you're using home equity line of credit as your down payment, that's absolutely allowed. Most lenders will allow you to use the HELOC for down payment. Typically, their wording is down payment from own sources. Well, if it's from your equity, it's from your own sources. So it would still need to be calculated into the ratios, because what's going to happen, even if it happens 90 days before your transaction, we don't see the money being deposited into your account, we're still going to see that there's a balance. So we're going to take that balance, we're going to calculate that balance into our ratios. Say it's $100,000, it gives us about a $530, $540 payment. That's going to get added to our application as a liability, and it's going to affect your ratios. So it doesn't really matter the timeline when you're bringing the home equity line of credit, unless you're looking at a very specific lender who wants to make sure that you're not borrowing any money, even from your own sources. We did see that last year. I want to say around this time last year, Scotiabank actually pulled back on their policies, and you could no longer pull out money from your home equity line of credit for down payment for at least for the first 20%. It had to come from your own cash and savings. They've since reversed that policy, and now you're able to use the home equity line of credit with them again. I hope that answered the question there.
I think it did. It did for me. And I just want to highlight, this information that Adam is sharing. I think it's really important for new investors to understand why you want to choose like the top 1% of people to work with as, people on your power team, people who are supporting you doing deals. I mean, Adam's talking about, what happened last year and how things have changed with specific lenders. And this really highlights why it's important to choose people like Adam who are knowledgeable in their fields and can actually set you up for success when it comes to financing. So thank you very much for sharing that, Adam, because I know, financing, especially for investors, is a little bit like a moving target. Like the lenders are changing their minds and we do corporate. Oh no, sorry, move that cheese. We don't do corporate names anymore. And, the game is always changing. So it's important to have somebody who's following up on that with you as well. Thank you. So George had said, does personal guarantee always mean reporting on personal credit and showing up on credit checks?
Typically, to the best of my knowledge, George, the answer is yes. Have I seen things disappear from credits or not show up on credit reports? Absolutely. Do some credit companies only report to TransUnion and it doesn't show up on the Equifax? Yes. That doesn't mean the lender's not going to see it. So I'm just going to kind of, as an overall general rule, if it's in your personal liability, it's going to show up in your credit report.
Good to know. And I want to highlight here the importance too of being honest with your mortgage people. I don't ever recommend being dishonest or trying to hide things from people on your power team. You know, if you're part of a deal and it's not, for some reason, it's not appearing on your credit report, I would not be trying to hide that and just assume that the next time your credit is pulled, it won't show up either. You know, I'm sure Adam doesn't like to have, you know, unwanted surprises when you're trying to put together financing for people because your clients haven't fully disclosed all of their obligations and responsibilities.
Yeah, and one thing that's really important to note that you know, full disclosure is very important in our industry because it can very easily be construed as you intentionally hid something from a mortgage lender. That's technically called mortgage fraud. It is a finance crime. It is punishable by jail time, I believe. And then you get blacklisted from any mortgage lending. Somebody like myself, you know, obviously not only would I lose my, you know, I could lose my freedom, but I'd be losing my license and my ability to generate an income. So, you know, always being upfront, full disclosure with everybody, no matter what those consequences are, because the opposite has even worse consequences.
Absolutely. And to be perfectly honest, you know, people as investors, we spend a lot of time talking about creative financing, but, you know, saying you're going to move into a property and getting, you know, 5% down or 10% down with no intention of ever moving in, that's not really creative financing. That really is moving into the idea into the realm of mortgage fraud. So it's an awful lot better to focus on creative financing strategies like joint venture partners and, you know, being able to negotiate discounts and those kinds of things. That's much more effective than pretending you're moving in to try and minimize your down payment.
Absolutely.
Perfect. And we have Diana had a question. Can you please tell me whether the following is a myth? I was told long ago that you don't want high limits on credit cards because it's the financial institutions perceive these amounts as potential high debt. So that's a great question because that gets asked a lot, right?
Yeah, I mean, that is a really great question. So the high limits will help improve your overall utilization 100%. Could they be looked at as potential high debt? Yes, some lenders, as I mentioned with the home equity lines of credit, will look at limits on lines of credit and potentially credit cards as well. Credit cards not as much because typically they understand that if you do have those high limits, you've shown a really great history of repayment, you're not somebody who's maxing everything out on a monthly basis, they understand that you're probably not going to want to stick a lot on those credit cards and aren't likely to have those in your debt servicing. Lines of credit, however, lines of credit, if they're over $50,000, sometimes some lenders will have a policy where they will have that limit calculated into their ratios as well. So again, it's just really specific as to which lender you're looking at, what their individual policies are. The majority don't look at it this way. So you could say that for the majority of lenders, this is a bit of a myth. But yes, you're absolutely right. There's some lenders that are going to look at that and go, well, these high limits, they could be maxed out at some point. So we're going to calculate those into our liability ratios.
Gotcha. So would you say in general, you're welcome, Diana. Would you say in general that lenders would rather see that you have, let's say, 5 or 6 different credit cards and lines of credit with lower limits? Or would you say that they would rather you have one credit card and one line of credit, both with a high limit? Would they rather see sort of the, you know, I've got the, you know, President's Choice card over here, I've got the Canadian Tire card over here, I got, you know, maybe a Costco credit card, and then, you know, I've got a couple of lines of credit. Would they prefer that or sort of the bigger ones?
Absolutely, because the other factor you're bringing into it is the types of credit, source of credit, diversification. So you're having many different pieces of credit from different financial institutions with lower limits, rather than just relying on one line of credit, one credit card with very large limits each. It's much more preferable to have the former option where you're diversified out on several different accounts with several different financial institutions than just to rely on 2 with very high limits.
That's really, I've never had anyone answer that, but it makes a lot of sense to me. But at the same time, I think most people are like, oh no, I'm just going to keep things simple. I'll just have 1 or 2 credit cards. But, you know, a lot of us, as we get into the world of real estate investing, you know, whether we're doing, you know, BRRRR projects or whether we're doing flips and renovations, those kinds of things, we have a tendency for us to go through periods where our credit is heavily utilized. And I think it's important for us to understand what the better setup is initially, as well as the importance of paying it back as quickly as possible.
Yeah, absolutely. And I don't think I have to tell anybody on this call, but keeping balances on those lines of credit and credit cards, is not a great long-term strategy. It's going to hurt your utilization. You're paying interest, a higher rate of interest than you should over time. But it certainly, as Elizabeth has mentioned, when you're doing certain projects, especially doing burrs and flips, and you're financing the renovations, you are going to have periods where you do have those higher amounts. Just making sure that you're very aware of how that's going to impact if you're looking to get into the next project and get that locked up and the financing finalized before you complete this project. How those balances are going to impact that next project is going to be very crucial.
Absolutely. So we don't have any more questions right now from attendees. So if you guys have any questions, we've got some time, and don't hesitate to put them in. But in the meantime, while we're waiting to see Adam, I'd love to ask, what is important for real estate investors to know in terms of what preparation do they need to do before, if they haven't worked with a broker before, or if they haven't worked with you before, how do they prepare for that? What do they need to do? What information do they need to gather? How does that work? How long would it take you to get them an approval these days?
Yeah, so approvals these days, right now, we're seeing large amounts of volumes that our mortgage lenders, different mortgage lenders are turning around, having turnaround times of 2 to 3 days. We have other mortgage lenders that are having turnaround times of 2 to 3 weeks and even longer. Being prepared with all the necessary documentation. So, typically if you're employed, if you have your pay stubs and T4s in one place, and you can quickly call up your HR department, get a job letter, great thing to do. If you're self-employed, making sure you know where your T1 generals and your assessments are. I recommend keeping everything in a file in the same location. For myself, we keep everything online on a Google Cloud, nice and secure, because your data security is obviously another important factor. Rather not see that you're holding things on your laptops and desktops and what have you. Technology has come so far these days. Google servers are amazing. If you guys are Gmail people with G Drive, they have great protection on there. Keeping everything in a nice location where it's easy to access, so that when you do have a conversation, sit down with someone like myself, and we go, okay, well, we need all these income documents, we need all these bank statements, we need all these, this, that, and the other, that you just have a quick and easy drive that you can pop them into our portal and get it all over and done with in a day, allows us to move along that financing process a lot sooner. If you lock up a property under contract because you want to take action and get things done, and then you come to me and you go, okay, well, I've got this and this, but it's going to take me a while to get my T1s, and I got my job letter, it's going to take me a couple of weeks to get that. That's when we're going to be working under the gun, where we might be able to get you an approval. It's conditional upon all those documents, but it's going to be a very stressful process that we go through as you go, okay, well, here's the one document you asked for last week, and here's the one you asked for 2 weeks ago. So having it all organized in one secure place is really the best case.
Absolutely. Love that. So I can't possibly let you go without asking 2 questions. And then Diana has another one too, which is, Diana, you got good questions. I'd like you to attend every webinar. Okay, so I can't let you go as a mortgage broker or mortgage agent without talking to you about interest rates, because this is the dreaded question. So what do you think, or what do you foresee based on your experience? If you had to anticipate by the end of the year, are we going to stay the same? Are we going to go up a bit? Are we going to go down a bit?
Okay, so that is a great question. Of course, this is one we're getting a lot. I'm gonna walk it back a little bit. So last year, around December, I was doing sort of my final year-end call to a lot of my realtor partners and saying, here's my outlook for the year. I started talking about how I thought that the Bank of Canada was going to start moving variable interest rates, the overnight lending rate, which impacts your variable rates, start moving that up in late quarters of 2022. This point, they were still saying, oh, end of 2023. But anybody with 2 eyes can see there's a lot of inflation coming into our economy. We know interest rates are set to go up. Variable rates, probably not until, I'd say now, second and third quarter of 2022 is what I believe. Fixed rates, we may start to see that move sooner, because what will happen is the Bank of Canada has essentially been buying up all these bonds, keeping bond yields low. So a bond, it's an agreement between you and the government that you're going to get interest payments over a set period of time. the price of those bonds go up and down. When there's high demand for those bonds, the price goes up, but the interest payment doesn't change. So that yield starts to go down. So fixed rates are based upon these yields because banks just borrow money to lend out on mortgages. So last year, we saw those yields start to come down. Interest rates went down. They started to go up around the beginning of the year. So we start to see rates go up. What we do know is going to happen prior to the Bank of Canada moving any interest rates is they're going to stop buying these bonds up. It's called quantitative easing. They're going to start slowing this program down. So that's going to reduce the demand in the bond market because they're one of the largest purchasers of Canada Treasury bonds. What that means is the yields will go up. And as those yields go up, we will start to see the fixed rates rise. So I would imagine that sometime probably in the fourth quarter of 2021, we're going to start to see those fixed rates start to rise. And then next year, we'll start to see the variable rates follow them. This may be a time, depending on your investment goals for your portfolios, to start considering if you are in a variable rate mortgage, to start thinking about whether now is the right time to lock in or not. Because if you're locking in next year when they're starting to go up, you're likely locking into fixed rates that have risen by that point. So I hope that answers the interest rate question.
It does. So would you, from a qualifying perspective, is it better? Can you qualify for more with a fixed rate mortgage on your other properties than with a variable because there's less room for things to move?
No, it's only going to be based upon the payment that's actually being made at that time, right? So maybe it makes sense if you're doing a bunch of properties around a certain period that if you do have some variable rates before you fix into, you lock into a fixed rate, which is going to push you to a higher monthly payment, taking advantage of the fact that you do have that lower variable rate to secure your financing now, and then locking in after that period. If locking in is the right choice for you at that time. But does it, when you're qualifying now, does it make more sense to be in a fixed or a variable for future financing? Again, it's really going to come down to your portfolio. Right now, the variable rates are lower than the fixed rates are. So having them on your applications now on your other properties and have lower monthly payments, which lowers your debt servicing, increases your capacity.
Perfect. Great answer. Love that. Okay, thank you. And Diana's question, when tenants apply to our rental units, we've noticed different companies, Equifax, Credit Karma, etc., give us different scores. Any one company more reliable than another? Which should we rely on?
Yeah, so we only look at, on the mortgage side, we typically only look at Equifax. Credit Karma is TransUnion. Mortgage lenders don't look at TransUnion as often. Which one's more accurate? I would imagine that they both have a lot of high integrity. I know TransUnion is well used in the US. So I wouldn't imagine they'd be any less reliable than Equifax. But just based on my knowledge of the market and what I'm used to seeing, I've never looked at a TransUnion score. I've always looked at the Equifax score.
I've always wondered how TransUnion stays in business because the majority of lenders use Equifax, like credit check people, the majority of us, we use Equifax. I can never quite figure out TransUnion.
They've got a market of over 350 million down in the US. They're being able to compete against Equifax again. So yeah, it's used a little bit more down there, I believe. Not so much here, but yeah, there are certain credit companies. I don't have a comprehensive list of who, but I do know there's some credit companies that report only to TransUnion rather than Equifax. So sometimes it doesn't show up on a report, but again, yes, 99.9% of the lenders will look at Equifax. We have heard of applications being declined because something came up on the TransUnion that wasn't on the Equifax. There was some reason that the lender decided to check that TransUnion. So it's not they don't rely on it. They will check it in certain cases. What triggers that? I don't know because I've not been through a situation like that before. I've never had to deal with TransUnion.
Gotcha. Perfect. Thank you. Well, Adam, I have to say thank you so much for your time today. So is everybody ready? Because there's Adam's email address. So first 5 people to email Adam and say, sign me up, will get Adam's very generous offer of Equifax reporting for a year, which, as we've learned, is really important so that we can monitor what's going on. And one thing we didn't touch on today, but there's a certain percentage of people out there who have mistakes on their credit bureau, isn't there, Adam?
Absolutely. I think I saw something. It's actually quite high. I think it's like something like 71% of people have one or more mistakes on their credit bureau. They can be just very minor mistakes. I see date of birth mistakes often. But yeah, just having a thorough review of your credit file through Equifax can help you make sure that you do point out these mistakes and get those corrected, especially if it's something major, something they're reporting that shouldn't be reporting. So yeah, always make sure you monitor your score.
Absolutely. Thank you so much, Adam. Fantastic of you to join us. We didn't give you a whole lot of notice either, so I appreciate that and your expertise. It's been fantastic, and really appreciate your time today.
Awesome. Well, thanks for having me. I really appreciate the opportunity, and thank you very much for everybody that joined.
Oh, absolutely. So for those of you who are interested, I will be hosting a webinar, one of my evening ones, on Monday, July the 12th at 7 p.m. We're going to have Christian Spilfogel and Darcy Marler joining us, and we are going to be diving into commercial investments and land development. So for those of you who are like, okay, I'm ready to level up. I've done the burrs and I've done the flips and I've done all those things, and I'm ready to do some bigger deals and to look at some bigger properties. This would definitely be a great webinar for you to attend. We're going to talk about mastering that transition. What information, what knowledge that you have right now is going to be transferable, and where should you be putting your time and your energy into leveling up your knowledge and building out your power team in order to support your transition into commercial investments and land development. So Christian is based in Ottawa, Ontario. Darcy Marler is out west. I think he's in Alberta, unless I'm mistaken. So we'll have a little bit of perspective from a couple of different markets across the country, and I really hope that you guys will be able to join us. Thank you so much to everyone who came today, and if you missed any part of it or want to watch some of it again, then you will definitely receive the replay in the thank you email that'll go out before the end of the week. Really appreciate your time, guys. Have a fantastic week. Happy Canada Day. Enjoy your weekend, and we'll see y'all again soon. Thank you so much.
Bye.
Bye.